Hello to everyone, and welcome to our grain market brief. It's going to be presented today by Brad Knight and Brendan Wallace. Just a quick disclaimer, just to point out that anything we discuss today is generic in nature. It's not specific to any individualised business. So if you require any individual support, please reach out to our grain marketing team.
Thanks, Brendan. So I just want to run through a few key messages today to think about as you digest the content, with the first being that really the only thing that we can accurately predict is continued volatility. It's becoming very true of grain markets or any markets in recent years, something we're very used to. So as you're thinking about what we're saying, please think about how we make decisions in these volatile environments. One of the good things we can share, though, is that global prices typically follow oil prices, but it is in the very long run. We'll present some charts and some data just to show where that currently sits and to show that this trend is clear in the long run. And when we're talking long run, we do mean over the course of months, if not years, not days and weeks. So we have obviously seen a pretty significant increase in oil pricing in the last 6 weeks, and only a moderate improvement in grain prices, and that is because we aren't really in a long run time frame as yet. But that is a key theme to take away from this presentation today. And finally, we're very clear on this as an organisation when we think about decision making, is that we really want to focus on what we can and you can manage. And make plans for what is essentially unmanageable market influences, but let's really focus in on what decisions can we make to actually manage our position in these markets. So where are we actually at? So I thought we might talk a little bit about what is happening in the Middle East and the broader impacts that occurring on what we're actually watching, rather than the day-to-day news, which is obviously quite variable in terms of what's happening there, and is day-to-day a lot of noise. But the few things we are watching at a broad sense is that, and what's important to note is that these just-in-time supply chains are very fractured in that environment. While that hasn't fractured grain market supply chains, it certainly has fractured input markets around fuel and fertilizers, and that's become very clear in those markets with pricing on those commodities. And probably what's more important from a medium-term perspective is what uncertainty will continue to exist around those assets in the Persian Gulf, and what damage may have been done, and what level of production capacity they may be able to return to if we get to an opening of the Strait. And alongside that is that recovery of those assets and even the flow of vessels will take some time. And again, we're not talking days, we are talking months. That historically, with other situations like what's happening now, it has taken anywhere between 6 to 18 months for those supply chains to normalise again when you look historically. So that does mean we are looking at a sort of a longer term scenario where there will be these supply chains suffering fracture. The recent ceasefire, what does this actually mean, and what time frame does that come into? There's lots of stranded vessels. There's around 200 plus vessels stranded, and they will take weeks to get moving altogether. And there's already been some. It's not just oil; it's also liquid natural gas as well, and clearly fertilizer. So we're talking about quite a dynamic environment about what is actually being impacted. But the key is, even if there was to be full opening, it will take several weeks before there is any return to what might be normal, and that does cause some changes in timeframes that we're thinking about. It won't return. Markets will have to take stock of that and will adjust more slowly than we probably would expect.
So just to reiterate what Brad said, so wheat follows crude, and we can see it through this chart here. Over time, this chart ranges from 2020 to 2026, and largely speaking, we've seen a pretty good correlation between our crude and our wheat price, where they tend to follow the similar trajectory, and yeah, particularly in the last couple of years, they have been very closely aligned. So that really puts the picture forward that if we see crude rallying, which that recent spike, that's due to the war in the Middle East, and we will see wheat follow that similar trajectory over time in the long run. Looking now at our 15-year CBOT wheat chart. So where we sit today, look, the market sitting, if we look at it, this is all in cents per bushel, we're sitting above 600 cents per bushel. So to put that in relative terms, if we look back over the last 15 years to put it in perspective, pretty well all bar this big spike in the last 10 years, the big spike in around 2022 to 2023, which was the Russian-Ukraine war. If we take that market noise or that event out, our current price is actually relatively high, given the market over the last 10 years. So where we're currently sitting from a US standpoint or the CBOT exchange standpoint is that current prices actually aren't that bad. If we follow, our Australian price has a good correlation with CBOT, numbers are going to be largely it's a reasonable price, and we're going to need some sort of additional supply shock to push this thing higher. Otherwise, we are somewhat capped to the upside in today's environment. So this is again looking at our wheat price. So this is looking out to March 27. Pricing has been, if you look at it at a range bound, we're sitting at a top of a range. So again, it's that supply shock. Where does that come from to push us to that next level higher? So if we put that into making decisions today in our own farming business, if we're at the top of a range and we're seeing prices sitting around mid 300s, what is the next driver to push that higher? It's either a localized shock, or if we're looking at global factors, there needs to be some significant event at a global level for us to see another futures increase. So crude, look, this is, I think this chart explains itself pretty well, that prices had been fairly static until we hit about March, and then we got to a situation where Brad's alluded to it with supply chains becoming fractured, and the closing of the strait prevented oil to flow, and that created significant uplift in oil values, and it's created shocks not just in Australia but at a global level, and as influences many markets, particularly currency markets, grain markets, fertilizer market, all our input costs, but it's also impacted global financial markets as well. So it has created a significant shock in the global economy. Rapeseed. So we've seen rapeseed market. So rapeseed as an oil seed has been on an upward trajectory over the last couple of months. So in around January, we've seen the market sort of come down and hit a floor price, which it's been a similar floor price all the way back through. Even we've seen it hit this level in May 25 and Jan 25, and then the market's tried to recoup some of that downside. And then again in March, we've seen the market really ramp up, and that's in around the Middle Eastern war, with oil being a crude oil being a dominant driver, rapeseed has tended to follow the crude prices through that period.
Yeah, thanks, Brendan. Great summary there on the charts, and I think very much showed the response of most markets has been upside in the last couple of months due to the Middle East conflict. But the real question we have, like you alluded to, is what, from a strategy perspective, what are we looking for next? What is going to be the driver of these prices? And obviously, a lot of that comes back to what does happen in the Middle East and the potential opening of the Strait. If it was to remain closed and continue to push oil pricing higher or even maintain current levels, then we will continue to see that correlation between the grain prices and that oil get closer and closer over time. But with a lot of uncertainty around the opening of the Strait, that's a clear sort of driver we're watching now, and then independent of that, we'll talk about it shortly. But we're very much looking towards what Northern Hemisphere crops do for those supply shocks that you mentioned. Just briefly on freight rates, it's important to note, I think, that while there's been a significant increase in road freight pricing domestically as a response to fuel costs here in Australia, global freight rates on boats have seen some response, but certainly not as big a response as we've seen in, again, similar to wheat, the wheat market chart you showed. Supply and demand shocks have more impacts on pricing of these markets than necessarily the underlying inputs to those markets. So we had the post-COVID demand shock. Demand for containerised freight went up significantly, so prices responded accordingly. And we've also seen a similar spike here as well. If we look at bulk freight rates next, once again, they've probably had more of a percentage increase since the Persian Gulf issue started. But they're still not at levels that haven't been seen before, and certainly very manageable for the current environment for shipping. What's probably created more issues for the market lately has been the uncertainty around availability and what freight rates may do, not necessarily what they are doing, and who bears that cost. Is it the seller or is it the buyer? And certainly from an actual physical movement perspective, if there were to be extensions of the conflict into other shipping routes, what impact does that have? So that there's been a lot of uncertainty there, and that has inhibited some export business from occurring smoothly in the last 4 to 6 weeks, which we will start to see impacting our local pricing soon. Taking a really sort of helicopter view now on global wheat and production, and I think why we are very much watching what happens from May, June, July onwards in the Northern Hemisphere. Northern Hemisphere dominates the production of cereals in the global market. So what their weather is doing, what they ultimately produce, is very, very important for the dynamics for the next 12 months as the global marketing period runs from sort of June to July across the years. So what this chart's showing us is the production estimates going back about 10 years, 15 years. So there's been a steady improvement in global production of wheat, which is, again, pretty well known, but quite a lot of volatility in stocks to use ratio, and that is how much stocks are being carried over relative to consumption. The stocks to use ratio is a very key figure we use to look at potential for market volatility. Other times we've seen significant market volatility in this period were very much around supply shocks and very tight stocks to use. So pricing was extremely volatile and quite high during those periods. Post that, we've seen a growth in production and a flattening off of use. So high prices cured high prices. And now we're in recent years been on a downtrend of where profitability on wheat has been marginal in spots. So production relative to use has been in decline again. And we are forecast to be seeing perhaps a tighter stocks to use ratio for some years. But the important note here is that it's not in an environment that sees extreme price action like we saw back in this period here in the early side of the chart. So that's what we're watching in the next couple of months, is what do these production estimates come out like, and what weather is happening in the Northern Hemisphere to potentially lead us closer to those volatile price environments. I said, yeah, May, July is our really critical time for that development of those Northern Hemisphere winter crops that were planted several months ago, and it is planting time for spring crops. So watching weather, very closely in these areas. And what's important, I guess, for the dynamics around supply and demand, and now the shock in input pricing, is that the input pricing has more effect on the current planting of crops, which obviously is happening here in Australia, but also the spring crops have been planted in the Northern Hemisphere: spring wheats, spring corn, row crops in the US particularly, corn and beans, very, very big global crops. And what impact does the higher input costs have on those plantings? Something we'll be watching very, very closely for some idea on what that might mean for the market looking forward 6 months. On those winter crops that are about to be harvested, pretty much all of the input costs have already been spent. So they're not seeing the uncertainty that we would see in what's been planted now. The other market dynamic is local crop establishment. That's very, very critical for local market sentiment and order flow. So what are farmers selling? Are they not selling? Are buyers looking to buy? Are they not buying? And we've seen that very much specific in the last 2 to 3 weeks around the dryness in northern New South Wales and Queensland. That market sentiment has turned very much towards the bullish side, with order flow very much on the buy side rather than the sell side. So that has seen that market rally significantly, and because of concern around the planting there, and that has actually helped prop up southern markets as well, particularly for crops like barley. So we're going to be watching domestic crop establishment across the East Coast and South Australia very, very closely for market dynamics. An example of one thing we watch in global markets is the US drought situation. So this is the US Drought Monitor that was released just about a week ago, and does show fairly significant parts of the major cropping belts through the middle of the US are in some sort of form of drought or severe drought. It's pretty common in this map to see red in it and orange, but this map does definitely have a little bit more red and orange than what you would sort of see in a normal season. And we have seen, that's one of the reasons we've seen some lift in US wheat pricing in the last couple of months, is that there is some concerns around their winter crop production. Important for the corn row crop areas, mostly sort of through this area. Like they're looking pretty good at the moment from a moisture perspective and drought perspective. So there shouldn't be any concerns around planting in those spots at this point in time. So how do we manage this, and what are the strategies? Mainly looking at strategy around what are the downside risks and what are the upside opportunities. So if we summarise downside risks, really into 3 points at the moment is oversupply. If we don't have some production issues globally, then we will have an environment where there is, again, ample supply, and that bearish global data will potentially see some of the risk premiums come out of the market. And then the other downside risk is around logistics. What do global freight rates continue to do around the oil price, and does that cause some in an oversupply environment, those logistics costs will be borne more by the seller than the buyer. In terms of upside opportunities, clearly weather threats are always there, which will lead into supply shocks, and possibility for demand shocks, which may be more structural around freight, which we will watch as well once the crop's actually grown. But particularly now, it is forecast for tightening global balance sheets will provide upside opportunities, and that will come from production. If there are some concerns there in the Northern Hemisphere, whether it be the Black Sea and Russia area, or whether it be North America or possibly Europe. So strategies for managing, we had a really good article in the InCrop back in March. So if you want to read that for further detail, I would encourage that. But one way we sort of manage trying to bring things into being controllable for us and making decisions is looking at two triggers. What actually makes a decision to sell some grain? It's either time-based triggers, which are around we need to sell because we need cash flow, or we're running a price averaging or a more objective approach to marketing where we'll sell a little bit on a regular basis basically due to unknown market dynamics. So versus say price-based triggers, which are about setting target prices. So they're not time-based, they're price-based. And that by using a combination of time-based and price-based triggers, it does help to capture rallies, because in an environment where you don't need to sell for cash or you're not running a specifically objective sort of sell down, what actually makes a decision to sell grain, and that's where we'll say set some target pricing, which will help potentially avoid some hesitation and result in less missed opportunities. And these really do help to provide some control and context over what is ultimately uncontrollable in being the market. And further, that is that I think making any decision is better than not, but also remind that sometimes not doing anything is a valid decision, but there needs to be some thought into why not acting is more important than acting. I'll throw to you, Brendan, to talk about some other tools we can use for strategy as well.
Yeah, so there's a couple of tools we can use in the toolkit to overlay with a business strategy to help make some decisions and help put things into context. So price deciles is one of those tools. So price deciles, look, it doesn't predict the future, but it helps put today's price into context. Is it an average price or is it a historically rare price? So, and looking at today's figures, are we sitting in a decile 5 type range or a decile 1 or a decile 9? So it helps to contextualize some of the decision making when we can see where current prices sit in a historical range. So it's not the be all and end all, but what it does, it just helps to put some context around where our current price sits from a historical standpoint. Along with the deciles, a budget. So all businesses should be running some form of budget, and a budget is used to essentially look at business viability and profitability. So at what point do we become profitable? So what we have aimed to do as a grain marketing team is to provide a budget forecast summary, just to put some robust decision making and rules around how we come up with a budget figure. So in this slide here that Brad's got up, so this is a Portland-based forecast where we set a budget price, a budget range, where our current market is sitting, and we also have a look at our decile 5 price. So if we can see here for ASW wheat, our budget price is sitting at 345. We've got a range of 330 to 360. The comments tell us why we've come up with these sort of ranges and these figures. So we can see our budget price is sitting right where the market's at today, and it's above a decile 5. So if this fits with if it's eliminating a business risk or locking in a loss from your own individual budget perspective, that's what we can use to help assist with decision making.
Yeah, so I've got some further prices on canola and beans as well. I think the important thing around this is an April, May, June forecast for sort of nearby market, and we do produce this for new crop markets as well. And like Brennan says, very much around just having a bit more objectiveness around decision making. And this, we've definitely have had a lot more interest in the last few weeks to a month from clients and the agronomy and farm biz team here at Pinion around what grain pricing may be doing, because the input strategies, particularly around nitrogen fertilizers, are definitely, they're always important, but they've taken on a new level of importance this year with the cost of that nitrogen and potential availability. So really using that those inputs wisely and even getting the crop mix at sowing time right has been very much a focus for the team here, and using these budget prices and ranges to help guide that decision making has been a really important one this year. So look, it was fairly high level look at the market, because it is very, very hard to get too specific at this point in time when we are right on the cusp of what is a time of 3-month period where a lot of information does come to the fore that will guide the next 12 months. So I thought it would be useful, Brennan, just to ask you, like what does this actually mean for strategy right now around what clients are doing? What are we actually telling clients, suggesting that they look at now from a old crop and new crop? So we've got two sort of distinct markets now with clients. So if I ask you, say with our South Australian client base, what does old crop strategy look like at the moment?
Yeah, so from an old crop perspective, largely from an old crop perspective across South Australia within our client base would be roughly 90% sold. So the approach has often been to take a longer term view and spread sales out. So that's in with forward sales, harvest sales, and then post harvest sales. So right now, look, our old crop stocks are running. They are pretty thin. There's still buying interest out there, although it has slowed. So the strategy now is around where is our business cash flow sitting? Are we in a strong cash flow position? Are we not? If we're holding grain and we require cash flow, that's not a sound strategy. Our strategy then needs to be liquidating stocks and turning it into cash, just to give the business some breathing room and flexibility. However, if cash flow is sound, and then we go into setting some target prices based on looking at current markets, looking forward with a view on where the markets may or may not head, and then we work on our time-based or price-based triggers that Brad alluded to previously as to when to engage with the market. But cash flow really is king. So, Brad, if I turn this around and go from an old crop strategy perspective, and looking back into the Victorian markets, where are you sitting at the moment, and how might this look?
Yeah, thanks, mate. Yeah, look, we've got quite a strong focus on old crop strategy at the moment. Given as a general comment, there's still quite a lot of grain yet to be sold and moved around all particularly cereals and lentils, canola and favour beans marketing programs are winding up for quite a number of clients, or well wound up at harvest time for many in the case of canola. But in terms of, we do have some southern clients with canola still, and we're very much riding the volatility of that of the oil market at the moment, and just trying to set price-based triggers for that, and a combination of time. So targeting any spikes, and but making sure we are moving some of that into the market all the time now, given the uncertainty. So that's what canola looks like. But most of the unsold grain we do have amongst clients is wheat and barley, and we've generally been running meeting cash flow minimum sales to meet cash flow requirements to give marketing opportunities through this May, June, July period. So really looking to see what local crop establishment looks like, and then forecast for their individual farm for the new season and what they may hold, spreading out logistics for those that run trucks, particularly, and trying to target close domestic end user sales, particularly given the cost of freight now with fuel pricing. But the majority of the strategy has been to try and buy some time to get to this June, July window where we do have the potential for global volatility. Given we have come off what has been a slightly like decile 5 or slightly below average price environment, it is trying to buy that time to get upside opportunity. So I might just predict the next question you may ask is, what does that mean for new crop? And from what was anyone who's holding a reasonably significant amount of old crop, say more than half of last year's old crop or more, new crop's not really factoring into the discussions at all. We do watch the relative spread between new and old crop. If there was a very, very big new crop price relative to current and a carry trade opportunity, we may look to sell new crop instead of old. But for the most part, new crop pricing old crop pricing is not really paying to carry all the way to new. So we're mostly going to see that old crop sold out before we start new crop marketing, particularly on cereals. So the only crop we probably are discussing some new crop strategy with at the moment is around canola. But once again, given the uncertainty around establishment and production costs around nitrogen fertilizers, we are seeing a fairly conservative approach to new crop selling amongst the Victorian client base. So what about South Australia, Brendan, given you've got more sort of unsold, more sold on old crop, but how is new crop strategy lining up?
So the new crop strategy, look, there is definitely with the South Australian market, we do tend to see more grain forward sold into any given season. And look, there has been some activity early, particularly on cereals, wheat in particular at around the 350 figure, and there has been some activity on canola in its recent run, which was centred around the Middle Eastern war. But really, the strategy comes back to what are the elements within the business that we can control, because the market's role is price discovery. Whereas it's the business's role is how can we operate through what the market delivers. So what are we actually in control of and what levers do we have to pull? So that's when to sell. So whether it's a time-based trigger or a price-based trigger, so setting your target prices or just having a rolling small sales more often type strategy. How much we commit. So are we selling large parcels, small parcels? Which tools are we overlaying? So to make the decision. So we talked earlier about our budget. We talked about using price deciles, a grains position report, using these tools to help assist with the decision making. They're not there to beat the market or to pick the top. They're ultimately there to add context to a decision that you're making on any given day. And then ultimately, how much risk the business wants to carry as well. So if we start working through these types of things, we can see today that we've got a price that's above what we budgeted. It's sitting in a historically rare from a decile perspective. We might opt to sell a small parcel of grain. We want to allow the business to have flexibility though as the season develops, as we get some more information around Northern Hemisphere crop production and global supply, and as our yield develops as well. So we don't want to lock ourselves in to not having that flexibility. So we're looking at selling small parcels more often, essentially, Brad, so that we've got that flexibility to move as the season develops.
Yep, no, it makes a lot of sense. Ultimately, production is always a hard one to put the finger on at this point, given it's very early in the season, and you overlay the complexity around inputs. It is going to make that decision making so much more important this year. So, well, thanks, Brendan. I think that wraps it up. Appreciate your time. Hope everyone found some value. Thank you.